Okay, welcome back. Now, from the sidelines of the JPMorgan India Investor Summit, we're now joined by Sanjay Mookim, Head of India Equity Research and Strategist at JPMorgan. Sanjay, it's always a pleasure having you with us here on the channel. Thanks very much. I remember listening to you as the conference was, before the conference, pre-conference, you and Sajid and others. And I remember you saying that it's very unlikely that this kind of outperformance here in India is going to continue, and eventually we will fall back in line. What's the feedback you've been hearing from people at the conference, big investors, your clients who are there, and any new kind of explanations or sort of thinking around this big outperformance so far?
Good afternoon. It's always a pleasure to be on CNBC. This whole summits that we have put together at JPMorgan, we've kind of labeled it as India's rising to the challenge. Right, and that is the kind of feedback that we've had in the multiple conversations, panel speakers, company interactions over the last couple of days, because there is this focus on both those key words. There is a challenge, right, and nobody denies the tough macro environment, the uncertainties which are particularly heightened right now geopolitically, economically, monetary policy-wise, India's external account, challenges and so on. So we did hear a lot about the external environment and potentially domestically also certain uncertainties for the Indian economy and the markets as such. But there was also this tone in conversations of how India is handling those challenges and the structural advantages that the country now has in a world that's looking barren for growth over the next several years. So the feedback is, look, we acknowledge that this is a bit of a difficult time for almost everybody. But in that sort of relative comparison peer set, India does appear to have far more structural advantage, structural visibility of growth than many of our peer countries might have, at least as things stand today.
Okay. Sanjay, hi, good afternoon. So the other key talking point has been the kind of buying that we've started to see in the Indian market from foreigners once again. Do you get a sense that that is going to continue and it was not just a flash in the pan?
So Anuj, let me kind of give you a little bit of a context to what has happened in my mind in terms of foreign allocations to India. If you look at a 20-year history of India market performance, invariably India has underperformed other countries or emerging market indices when oil prices have gone up. So it was reflex for most investors earlier in the year or even late 2021 to sell India and go underweight India because we all agreed that oil prices are continuing to go up. This is the first time in 20 years that has not happened. Right? And so everybody was caught unaware. This is not what you were taught as an experienced fund manager. And this is now causing a little bit of catch up. Okay? So first, India's performance is advertising for itself. And then the second leg of this argument, Anuj, is the fact that people are now less certain about a Chinese reopening and Chinese economic outlook than they were perhaps earlier in the year. So a combination of a lack of choice of other large countries and other large markets, plus this whole performance of the market speaking for itself, I do see a renewed amount of interest amongst investors in looking at India, in saying, hey, look, something's going on. Should I be a part of it? And how do I participate in whatever's happening in the market? The challenge, and if I may leave with this comment, Anuj, is that once you land up here and start looking for fairly valued stocks, you kind of struggle a bit.
Hi, Sanjay. Good afternoon. I've been listening to what you had to say, but if you look at a fairly valued index, then maybe India's, the Nifty is at close to around 20 times, 19, 20 times odds. So we are at the higher end, or we are relatively more expensive as well. Do you believe at some point of time, we are at the higher end, so do you think some money could find its way maybe to markets like China, Latin America, and the others, or do you believe that we could sustain these premium valuations?
Good afternoon. Now, the reason I have been a particularly, nonplussed or let's say worried about over the last, like say, 4 or 5 weeks is, our outperformance to China is probably explainable. Or I can rationalize that because of the issues with the Chinese economy and so on. But this recent outperformance to the S&P 500 is a little bit more difficult to rationalize. It's because the S&P is a hard currency. It's got better near-term earnings growth and it is cheaper. Right? So if I were an asset allocator, all kind of metrics and I can analyze, I would still prefer the developed market hard currency asset over an EM Indian growth for now. Yes, of course, if you're willing to invest for 3, 5, 7 years worth of outlook, then India may provide longer, steadier growth, but very few in equity markets, as you're aware, have that kind of luxury of investment. So this little bit of outperformance that we've seen over most other economies or markets in the last few weeks, that makes me a little bit nervous. And that's what my initial comment was earlier, that there is a risk of a bit of a catch-up of Indian markets on the downside.
Sanjay, without naming names, of course not, are there any large funds which have been raised for, say, GEM funds ex-China, EM funds ex-China, that kind of, have you heard of it? Is that happening? What can you tell us? Yeah.
So it is certainly in conversation, and I've heard multiple people attempting to advertise market funds which look at an emerging basket outside, not just perhaps of China, but even North Asia, right, excluding the Korean, Taiwanese market as well potentially. And if you do that, India will probably be a third or 35% or 40% of those kind of baskets. It is difficult to see how much money will eventually be raised for such kind of strategies, but this is part of conversation, and I've firsthand had chats with people looking to advertise and market this investment strategy.
Okay, we were talking to your IT analyst Ankur this morning, and he sounded extremely bearish on the sector. Are things looking that dire, or is it just because of the context in which we're talking now, the valuation context, and what's happening in the US? Because from the peak, the stocks have corrected about 30-35%.
So Anuj, this is consistent with our investment philosophy, right? And especially if you're a one-year investor or a shorter duration investor, it's not necessarily about earnings growth or the PE level, but about surprises. And we've done a lot of quant work. This is fairly well established that stocks tend to react to earnings or outcome surprises more than they react just to growth. And for the IT sector, we still think there are negative surprises due, right? And this is partly in margins, but that is now played out to some degree. We've seen margins come under pressure from the whole cohort in the last quarter. That is likely to sustain near term. But we also fear that the top line outcomes we'll get out of the Indian IT companies will be worse than what consensus has predicted. So earnings projections for IT companies may have to be revised downwards. That then combines with the fact that multiples are a little bit higher than they used to be, and you could get a multiple compression as well should outcomes start to disappoint.
Sanjay, what about the domestic themes? They have been looking up, and the street believes that the second half of this year is going to be great, and from then on we're going to see growth. One sector that's really re-rated has been cement, maybe because of the new player that's coming in there, but suddenly you have all domestic large players who are going to be out there. They're going to be on the prowl as well. But otherwise, valuation-wise, I mean, some of these stocks are trading at 16, 17, 18 times EV upon EBITDA. I haven't seen that in the last many, many years. Do you think this is justifiable, or do you think they pretty much run their course?
Well, we are in the latter camp, unfortunately, and there is obviously a lot of excitement because of the change in industry structure that we have seen recently, with people talking about consolidation happening very rapidly. These are difficult to do things, we imagine, and also if you start off from the point that no cement company is really in distress, there is no hyper leverage, excessive leverage, and at these valuations, the merits for buying something out also is debatable. So while the market would expect consolidation to happen, we don't see why there'll be too many of these people wanting to sell in the first place, because these companies no longer have leverage and they're making enough money to begin with. So I do think that you may get some, but the kind of consolidation that is being priced in might be too ambitious. And the other challenge we face is that the forecast growth in capacity over the next several quarters is likely to end up being far more than any demand growth we'll see in cement.
Sanjay, what is the I'm sure I should have asked you to think about this for a while, but what is the most non-consensus thing you've heard at the conference this time?
Well, I don't know if it's non-consensus or not, but we're starting to hear on the margin a little bit of commentary from corporates about a little bit of slowdown over the last couple of months. Now, this could be, a blip in the trend of reopening or whatever, but we wrote research after the June quarter saying, corporate commentary is really bullish, especially from a domestic consumer view, but we're starting to hear a little bit of a more somber tone from companies. This could be the fact that Diwali is due in a month, and consumers might be holding back for whatever discounts are available around the festive season. But that is something that has caught our attention as having changed in the last, let's say, month or so.
Okay, that's quite interesting. So, does that change the way some of these consumption names have outperformed, or does it outperform and still remain intact?
No, I don't think this is going to sustain, Anuj. And this has got nothing to do with the corporate commentary, of course, because arithmetic will suggest that as you enter the December quarter, you will get two things happening. Sequential momentum of sales improvement is slowing simply because most of the reopening is largely done and the benefits of reopening have been accrued, while the base effect for many of these companies is going to catch up. So the reported growth numbers that you will get from the entire consumer pack in India is actually going to come down very sharply from where it was in the June quarter. And in the context of these companies trading at 70, 80 times multiples, suddenly if you see single-digit growth numbers on volumes, that might be a little bit difficult to digest. But worryingly, what I fear is that those numbers will actually come in below forecast. And that could be a dampener again to this whole momentum of how this consumption story has got legs to go forever.
Okay, all right. Sanjay, thanks so much for stopping by and giving us your thoughts on the markets and sharing feedback from the conference as well. It's always a pleasure talking to you. Well, for the time being, a quick check on the markets. We've moved a little bit lower in the last 10